Today, we will be discussing bank debt for acquisition. The idea is that for you guys as brokers, this should just be a high level primer and sort of introduction into the minds of the bankers in terms of what they're expecting from someone who's looking to raise some debt for an acquisition. And I think it's just a good tool for you all to have in your toolbox. So when you're dealing with a potential acquirer, you have a pretty good idea, should they be seeking bank debt, whether or not they're likely to qualify. So it's certainly not, again, an exact science, at least from our perspective. We don't know exactly what goes on behind the scenes, and we certainly don't want to make any assumptions about people based on, just what we're guessing. But I think it's a useful piece of the transaction to make sure you have a good grasp of. So generally, there are two sort of traditional options. Nowadays, you can get debt from quite a few different places. There are a lot of non-traditional lenders that have kind of popped up. But generally, most people are going to be going the traditional route, and there's sort of a few different things that pretty much everybody is going to look for. So the first option is the SBA term loan. There's quite a few variations of that program, variations of term loans, and there are different programs under the SBA sort of lending guidelines, but generally their term loans are 5, 7, and 10-year terms. They're relatively affordable interest rates, so there's like maximum rates that banks can actually charge. It's a pretty good deal if you can get through the program. There's definitely personal guarantee that is required. The underwriting process is slow and tedious. Sometimes it's 6 weeks or more. I should say almost always it's 6 weeks or more. We've had some that have dragged out for months. And generally, it's a situation where you need to work, and we kind of always advise that you need to work with some of the smaller banks because they have a better appetite for this stuff. They seem to like it. The caveat to that is they don't always work as well with the SBA as kind of the big boys do. A lot of the major banks have underwriting authority with SBA, where if a big bank says, hey, this is good enough for us, then the SBA says, okay, well, if it's good enough for you, then it's good enough for us too. The small banks, the community banks, a lot of the credit unions don't have that same reputation, or I guess relationship is probably a better term, with the SBA. So it can be slow. However, it's better for some of the riskier deals that banks struggle with independently. So real estate brokerage is a good example. They're fairly high risk from an acquisition perspective. There's not a lot of sort of even customer generated revenue that you're buying in terms of future income. It's a lot of kind of future performance that you're sort of banking on. So sometimes stuff like that's high risk, the SBA will have no problem subsidizing, but banks may not touch it themselves. Generally, they require a 25% equity injection. The nice thing about this is that 25% can actually come from different places. So it can be cash. It can actually be seller debt that is retained, or some sort of seller equity. The caveat to that is, while it's nice because you can get a little creative with it, the seller debt must be delayed and cannot be repaid until after the normal debt, the SBA debt, the bank debt, has been fully repaid. So while it's nice for the buyer, some sellers obviously don't love that. Now, if it's only 5 points and it's a pretty big deal, and they're only asking again to carry back that 5%, then okay, maybe they're okay with it. If they're asking for 25% or 30% to be carried back, well, not so much. Generally, and just one kind of final point on that, you're not going to get away with putting 0% into the deal, right? No one's going to do that. So you should expect buyers at a bare minimum to be bringing 10% in cash to the table for even the SBA to be interested in it. Traditional bank loans, fairly similar. They're obviously involved in the SBA process, so there's a lot of similarities between these two things. They're generally 3, 5, and 7-year terms. Occasionally, if it's a really big deal, you got a good banking relationship, you can get it dragged out. If real estate's involved or something like that, obviously it can change as well. That goes for SBA term loans as well. But generally 3, 5, and 7. The interest rates are usually prime plus, so whatever the prime interest rate is, and then based on the borrower's creditworthiness, the business itself, so on and so forth, whatever they're charging on top of prime obviously moves a bit. There is, again, almost always a personal guarantee required unless the buyer is really, really strong and the business is big and makes a bunch of money and has a bunch of fixed assets. Underwriting and approval can be much faster. However, there's definitely banks, even without SBA involvement, that take a long time to underwrite. So it's just going to depend on the bank, but generally speaking is much faster than the SBA process. Most banks, especially on some of these smaller deals and where the buyer is maybe buying their first business or, doesn't have a super strong personal financial statement, they're going to require 20 to 25% in terms of an equity injection, and they're almost always going to require that that's actual cash, that's coming from the buyer. They also require a strong personal financial statement, so they're going to want to see equity in houses. They're going to want to see 401k or pension money. They're going to want to see that the buyer has made good financial decisions for a number of years consecutively. As a result of that, you will see sometimes, and it depends on the risk level of the deal, depends on how strong the business is, how strong the personal financial statement of the buyer is. You'll see what's called cross-collateralization of assets, and that would mean, hey, okay, we're going to lend you $150,000, but we want you to put $100,000 into a CD at our bank until we know that this is actually going to work out and is going to be a performing loan for us. So kind of the two main options there. Again, you'll occasionally see private debt that's not seller financing, and that's usually going to be either on really large deals or with someone who has maybe poor credit, and they're going to kind of these non-traditional lenders that are out there. I think On Deck is one, Seek Capital. There's a few out there, and they may get involved. But generally, these are kind of the two different sort of debt options that people sort of seek out. Both are sort of considered bank debt. However, SBA is obviously appealing for those who don't mind waiting a bit and can get through that process. So if you guys have any questions on this, want to discuss bank debt or general requirements sort of as we understand them, please let us know. I'd be happy to walk you through it. We can put you in touch with some lenders who can kind of provide more insight and sort of 100% accurate look inside in terms of requirements. But again, pretty straightforward and a good tool to have in your toolbox.